Hello, and welcome back to our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, this week we're going to shift from talking about the economy to talking a little bit more about corporate America. Markets have spent most of the last year or so asking whether the economy could avoid a recession. And today, that isn't really the debate anymore. The economy has avoided recession. Instead, the question is whether earnings can continue to justify stock prices after such a strong rally. And that's going to be the theme over the next several weeks. So, looking at last week and year to date returns, we can see that last week performance was fairly mixed. But the broader story really hasn't changed that much. Value, small caps, emerging markets, and commodities continue to be among the year's strongest performers. Now, that broadening of leadership is something we've been talking about for several months, and it's generally a healthy sign for the continuation of the bull market. Now, the economy isn't perfect. Housing remains sluggish. Trade will probably weigh on second quarter GDP, and inflation hasn't disappeared. But that's very different from saying that a recession is around the corner. Overall, the economy continues to look like it's slowed, and it's slowed toward a more sustainable pace rather than falling into that contraction. Now, the chart on this slide shows the quarterly change in the U.S. Purchasing Managers Index, and that's a survey that goes out to the various purchasing managers in the economy. And we can see that it's flipped to positive, which has historically been a good environment for stocks. Now, looking at earnings season or thinking about earnings season here, this is probably the single most important chart of the week. Normally, analysts spend an entire quarter reducing earnings estimates. Now, this quarter, they did exactly the opposite. They raised estimates by over 3% throughout the quarter. And that's extremely unusual. Now, the good news is that fundamentals have genuinely improved. And the challenge, though, is that expectations have improved too, and markets may become more difficult to impress with the elevated expectations. Now, we've been saying for months that eventually this rally needs to transition away from companies building the AI infrastructure toward the companies actually benefiting from AI. And we're actually beginning to see some early evidence of just that. So, productivity stats are improving. And as this chart shows, revenue or sales per employee is also improving. And if that trend continues, it provides another leg underneath this bull market in which it can stand on. So this slide here summarizes the pros and cons in the market right now. And I'm not sure that a black and white bullish or bearish view is really appropriate. Market bulls are certainly right that fundamentals continue to support the market, and market bears are right that expectations have become elevated. And what that usually means, rather than a black and white bullish or bearish environment, it usually means a market that becomes a little bit more choppy or volatile, and leadership shifts can happen frequently. And that's why we continue to emphasize diversification and discipline in your strategy. So here's what we're watching to inform our view in upcoming months. Earnings themselves matter, and the banks will get us going here soon for the second quarter earnings reports. Guidance may matter even more. What the execs are saying about their businesses in terms of inflation and interest rate pressures, as well as the AI adoption, that is going to be important. And what companies are facing in the second half of the year, that'll likely determine whether this rally broadens or pauses. So, of course, we're watching market breadth as well to gauge the health of market trends. And thus far, all of these have at least cooperated. Even inflation looks like it can moderate as the year progresses, as that energy shock dissipates. So, if I had to summarize everything into one sentence, it would be this: the economy has largely passed the test, and now it's corporate America's turn. So the next several weeks will tell us whether earnings can continue supporting a market that has already priced in a lot of good news. And fortunately, the evidence does still lean constructive, and that's why our overall positioning remains constructive as well. And that's what we have for you this week. And as always, I want to thank you for joining us and wish you a great week ahead.